core inflation just hit another 40-year high at 6.6%, which was above the estimate of 6.5%. While core CPI does not represent at all what Americans experience every month for their budget, it is the Federal Reserve's preferred method of measuring inflation, which means a higher likelihood of the Fed not pivoting. Now, considering this comes on the heels of the Producer Price Index also exceeding forecast, and the overall CPI still being above 8%, with many categories experiencing year-over-year inflation of over 30%. This is a big indication of more pain ahead. Ready? Let's dive in. Typically, the Federal Reserve likes to look at core CPI instead of overall CPI because core eliminates things like food and energy, which they call volatile, but really that just means people have to buy those things. The demand is what's known as inelastic. And so regardless of what happens to the rest of their expenses, people will continue to buy food and energy because they have to. And so it's going to show up as worse than the core CPI, which we can clearly see here if we look at the inflation numbers for September. Overall CPI is at 8.2% and core is at 6.6%, which is still a 40-year high. Now, if we look at producer prices, which are more of a leading indicator of prices, we are seeing that over the last couple of months, producer prices are increasing and they climbed 0.4% in September month over month. Now, I'd like to look at this breakdown of the categories for the CPI to show where some of the price rises and declines were. The big standout shocker here is food at work or school increased over 90% year over year, while things like energy and food at home experiencing massive price increases. But I'd also like to point out something here that's holding the overall CPI numbers down, and that is the things that are showing price decreases. If we look down here at the bottom of the chart from CNBC and we see smartphones are down 21%. The way they get this number is by looking at calculating the amount of computing power per dollar that there are in new smartphones. And since the newer smartphones coming out every year are more and more powerful with better and better chips, it really doesn't matter if the price on a new iPhone goes up by $100 or $200 because the amount of computing power that those chips have is so much more that it looks like a price decrease. And that is actually what they do when calculating the price of computers, televisions, smartphones. This is why it looks like deflation when even if the new cell phone every year, the new iPhone that comes out every year goes up by $100 or $200, it looks like the price of those iPhones is going down because of those chips being so much more powerful than they were last year. Now you can make an argument that there is some deflation there because over time you can use that greater and greater technology to do things where you can replace your other technology, your other expenses with your phone. You can do things that make you money. There are the ability to have more creative apps where you can do video editing and you can produce things that you can sell online with just an iPhone now. But the way that it's calculated is certainly going to have a negative impact on the overall CPI because they're just taking into account basically raw computing power and making that a dollar for dollar loss when really people are having to spend more money on cell phones, not less. The other thing I'd like to point out here is we have this uncooked beef steaks fall, 4.8% year over year. However, we have an increase of something like poultry, 17.2%. So let's say you're a rational person and you're looking at poultry and it has gone up 17.2%. Last time you went to the grocery store, you were like, hey, this chicken was $10 and now it's $12. That's a big increase and maybe I don't think the chicken is worth it anymore. But last time I was here at the store, I saw that this beef was $15 and now the beef is $13. So the chicken went up in price and the beef went down in price. What do you think I'm going to do as a rational consumer, especially if I like beef more? What I'm going to do is I'm going to buy the beef instead of the chicken. This means that price changes in and of themselves change consumer behavior, which is rational. This means that prices changing, one of the results of that is that prices stop changing. And so you can't just measure the price changes and say that that is inflation, because when prices change, consumer behaviors change, which means that what you're capturing is no longer the price change that would have happened as a result of the increase in the money supply or as the result of anything else that's causing that inflation. What you're really measuring is just the cost of surviving, not the cost of living. Now, is this the best method that we have for measuring inflation? Maybe, but it's worth pointing out that this is a little bit self-referential here, and you cannot accurately determine how people's cost of living is being impacted, because the cost of items changing in and of itself changes behavior, which means that you can no longer measure the changes in cost that would have happened if the behavior would have stayed the same. Now, finally, I'd like to point out something. This is an indicator that I tweeted out a few days ago. This is cost of shipping. This is the freight containers dropping recently here. And this is what I'd like to put, for years, it was very, very stable. Then there was the big skyrocket when a bunch of the money started working its way throughout the economy. And all that money was built on easy credit, on cheap debt. The expansion of the money supply caused supply chain issues and all of that. And then once the money ran out, this kind of stabled out, and now there's a big collapse. The boom makes the bust inevitable, because the boom happened as a result of the money supply increasing, but the money supply only increased as a result of artificially easy debt, artificially easy credit. And we know that debt must either be repaid or defaulted on. And so as that process happens, now the money supply in circulation starts to collapse, which means that prices start to collapse as well. So it's not a business cycle. It's not a regular economic cycle. It's a boom and bust cycle that is created artificially as the result of intervention through central banking. And this is clearly evident here with the cost of containers, which means that as we continue to tighten to rain down on the inflation that's happening elsewhere, we're going to be experiencing more and more economic pain as we have deflationary crashes and collapses that started in asset prices and are now making their way other places. And we're probably still going to have high inflation in costs of things that people will continue to have to buy, like food and energy. As always, I really appreciate you guys. Thank you so much for watching. Have a great day.